Hello, I'm Richard Gonclaves. Welcome to the Thursday edition of Market Moves. Tonight, Can West finally offloads its 10 stake, so where to now for the network? No fun at Kentucky for Karoon, with a projected reserve not as big as first thought, and record numbers from David Jones, so why were shares lower? Everyone's talking about some sort of a pullback, right? Sure. And what I hear in terms of the theme is that there's going to be if there's going to be a pullback, there's going to be some sort of left of field event that no one's expecting. And I know this might sound like a stupid...
So people are expecting something that's not expected. Yeah. Oh, very good.
But this is going to be the stupid question. But what could potentially be the trigger? I mean, are there worries in the UK about the banks there? Could something bad here happen in terms of the bank and bad debts? You know, what could potentially surface?
Well, look, the RBA's report came out and said the financial system's a lot more stable. 6 months ago, they said there was a lot of uncertainty and things were incredibly... risky, if you like, and people were risk averse. Now the equity market's gone up, commodity markets have gone up a lot. Credit markets seem to be stabilising, if not getting a little bit better. Although if you talk to some property people, they'll say it's still tough. But if you have a look underneath all of the optimism, I think it's 1 in every 11 home loans in the United States are in serious default, so more than 90 days overdue. A third of all home loans in the United States, or a third of all homes have negative equity where there's a home loan. So it could just be that people reappraise what we've known about for a long time. There's the Alt-A mortgage resets, which are occurring, the Alternative A mortgage resets, and the option, the ARM, the adjustable rate mortgages, they're all resetting. There's more of those than there were subprime loans. They're resetting in 2010 and 2011 in a big way. But all this is known, so the market has been rallying. Despite that, it may just be that the market looks at these things again and says, well, it's sort of more of a worry than what we originally anticipated. I don't know, and no one does. Yep. But I think what's more important is to look at individual businesses, and they seem expensive again.
How expensive?
Well, you know, I value individual companies, and then what I do is I pull all those valuations together and weight them by market capitalisation to get a proxy for what the market is worth, and it's worth about 3,960 points, yeah?
Right, so that's 600 points below where we are now.
Market's about 20%, 20% above my valuation. But let me say this, historically in Australia, the market tends to be expensive.
Right.
Why? Because there's 3,000 funds chasing 2,000 stocks. And if you look at large cap stocks, there's even fewer of them. So they tend to be higher than my values. My values tend to be very conservative. And so I'd expect them to always be 10% over or 15% over, but not 20. Okay,
so in other words, just for mum and dad that's listened out there thinking, hey, the market's at around 4,700 and your value that you put on there is 3,900. Does that necessarily mean that you expect the market to fall?
No, this is really, really important, Richard. Just because my value is down here and the market is up there doesn't mean I'm predicting the market will go down. It just means there's not a lot of justification in terms of businesses' values for the market to be where it is. Now, the market can stay where it is for a long time, and it might be that it stays there for a year or two and the values rise and the value catches up with the market. That could happen.
Right.
Generally, that doesn't. Generally what happens is you get some overreaction and the market becomes cheap again, and that's the opportunity. But I think I said this to you last time, the time to make a lot of money in the stock market was actually back in March this year and May and not right now.
Okay. Let's talk about commodities if we can right now. First of all, Danske Bank is suggesting some commodities may be running out of steam, with aluminium unable to hold 2,000 US per tonne and oil at 70, equally off its highs. The group points, however, that the market is becoming more selective in its pricing of commodities, which in general is bullish. Oil's inability to break 75 US per barrel means energy prices are now trading more according to fundamentals. Still, it expects a tightening in the market supply and demand balance to become more visible in coming months and should see prices trade close to 80 by the end of the year. Copper should test 6,700 US per tonne in the December quarter, with copper stocks still and record lows, with demand set to pick up and OECD economies recovering. And it sees limited upside in aluminium prices though, because stocks are at record highs. What's your take on what that bank's saying?
I don't have the skills of that bank in terms of the preciseness of where I think things are going. But I do know a couple of things about commodities. With regards to oil, the credit crisis, the global financial crisis that we've just had, means it is very, very tough to get a loan to go and explore for oil. It's tough to raise capital to go and find oil. And so the high prices trigger exploration. People say, well, look, the prices are high. If we can find some oil, even if it's expensive to extract, let's go and find it. That's not happening. So there's less oil being found now than there was 2 years ago, and there wasn't a lot being found 2 years ago. That to me suggests a bullish undertone and some support for higher oil prices. The same thing is happening, and what we've seen in the stock market pales to insignificance compared to what we've seen in copper, for example, and other metals. The problem that I think is that every time central banks have pumped billions of dollars into economies, and remember they're doing it globally, and they have been doing it globally for a long time, at the end of a decade it shows up in inflation.
Right.
And some market, I don't know what it is, but you get a lull in the middle of the decade, and then you get some pump priming by central banks, and towards the end of the decade some markets go up. And I really think that the market that's going to keep going up is commodity markets, be it agricultural commodities, metals and energy, the energy sector. And we're seeing that now. For the reasons I just explained, we're not going to see a lot more oil supply come onto the market, and I suspect we'll see higher oil prices. All the money being pumped into the economies of the world is going to show up in inflation. Buffett said it, Soros has said it, Jim Rogers has said it. I mean, these guys are being ignored at the moment. Are they wrong? Okay. I think they're probably going to be right.
And we'll talk about Buffett later on in the program, but for now, let's go to Outperform. Outperform is when we ask the brokers which stocks they are buying for their clients to outperform the market and outperform their competitors. What are you liking right now?
McMillan Shakespeare is significantly lower than its intrinsic value, and it has terrific cash flow, no debt to speak of, massive return on equity. It is still relatively cheap. There aren't many companies that are cheap at the moment. The other one is JB Hi-Fi, and despite rallying to nearly $19 at the moment, I think it was $19 during the week, I don't follow it every day, and you might remember I've been mentioning it since It was sort of $10 or $11. I still think it's worth $21 or $22 in a year's time. So it doesn't seem to be overly expensive. And in a world where there's a lot of mediocre companies that are expensive, and here are two businesses that seem to be very good quality that aren't. Oh, by the way, Richard, I know people hear me talk about these companies and they go and look at a chart and the chart's gone up.
There's the chart.
There's the chart. The price has gone through the roof. And everyone's saying, oh, Roger's saying outperform, but hang on, I was saying outperform a long time ago.
Absolutely.
It still isn't expensive. And the last time I was on a few weeks ago, I said, look, it's not expensive. It's gone up again. I don't know if it's going to keep going up, but I do know that its value is higher than its current price. And generally, you want to buy businesses that are good when they're cheap.
Yep.
And that seems to be the case with McMillan Shakespeare and JB Hi-Fi.
Okay, there you go. There's two picks for our Outperform segment. We've got plenty more to talk about after this. Next, the day's winners and losers.